So we're absolutely honored to have Jeffrey Bronchick here with us today. Jeffrey Bronchick is the founder and a portfolio manager of Cove Street Capital. He has over 35 years of experience running research-driven, concentrated, value-based strategies across all market capitalizations. Prior to founding Cove Street Capital, Mr. Bronchick was the chief investment officer and a lead principal of Reed, Connor, and Birdwell, a Los Angeles-based investment manager. He was one of the first columnists for The Street in the 1990s, and then moved on to a similar role with Grant's Interest Rate Observer's first online effort. Mr. Bronchick previously worked in equity research, sales, and trading roles at Neuberger Berman, Bankers Trust, and First Boston. Thank you for joining us today, Mr.
You're very welcome.
So excellent. Let's dive into the questions. So our first question is, can you please discuss your process for sourcing and researching investment ideas?
The source. The source is, should I do this? Should I do this? That's the source. It's 360. And so what you learn over time is that you can't only trust the quantitative side, and everyone in the world can, screen for stocks on every known technology platform known to man. People can talk to people. Like, I know a guy, or my dad said, you should look at this pancreatics, drug stock because he's a doctor and he must know what he's doing. You can't just, oh, I read it in the newspaper, blah, blah, blah. So the reality is sourcing and evaluating ideas it's really a 360. And it's good investing is always a combination of the quantitative and the qualitative. And we sort of look at it through these lenses of what we call business value people. And so we use all these tools. And again, over time, we've got, dozens and dozens and dozens of years of collective experience, not just me, others. I'm adding to that. I'm only like 3 dozen. We have dozens and dozens and dozens of contacts, hundreds of contacts that we have spoken to in the past or may look in the future to help qualitatively understand the math we're looking at and its likelihood of either inflecting or continuing. And then whatever you're thinking today, guess what tomorrow is? A new day to reconsider, rethink, recalibrate. And so really it's a constant process. So we do all those things. We screen for stocks because we focus more so on the smaller cap area. So of which there's thousands of companies. So how do you keep track of them? Hey, there's this computer thing. You can actually put in parameters that roughly, so you have ideas come from there. Again, we probably talk to people here, 5 or 6 companies a day. So you're always getting feedback about, hey, there are a shortage of this in their supply chain. Like, well, who makes that? That wasn't on the screen, but this and that, as well as, what you try to do is, as the helpfulness of age and experience is, you try to, number one, remember some of what you've learned, but number 2, employ it and come back to the well. And many times, as you'll see in your career, is an old joke of, you can make all the mistakes you possibly can in the investment business your first 5 years, then you spend the rest of your life avoiding making those same mistakes. But often you come back to things, and some research or interesting idea that a guest gave you on a podcast was great, but you know what? 3 years from now, it clinks in. Like, there's the business that was really interesting, the management team that's properly incented, and for whatever reason, a general market, you mentioned March 2020, like, oh my goodness, like the stock just went down 38% for other stuff, not diminution of the business model. I'm stepping in. So really, that's what we do. For our firm, there's really 5 of us on the research team. We all sit together in a common space, but really that's what we spend our time doing, is a combination of evaluating spreadsheets and making sure, because as we like to say, in God we trust, everyone else brings numbers. But again, like every good idea that you say, wow, that's really good, it has an inflection point where it starts to be less good. And so doing good math and understanding, fleshing out history and where it's been and That's one thing. Understanding management and their history and who's on their board and how are they getting paid and how that's changed is another. Doing in-depth industry research is another idea. It all sort of combobulates into our process. So that's how we do it on the
Oh,
sourcing.
that sounds excellent. And then also, what inspired you to start Cove Street Capital?
Yeah, these are the good fun questions. The rest of the stuff you can get in a book. I was again, there's two ways to go through life. The exalted way, where your parents were, investment managers or private equity or ex-Harvard Business School, and you studied hard, and you got, in the day when they had SATs, you did well on your SATs, you got into a good college, you were surrounded by people who were also doing that, and you were magically got the 2-year analyst training program coming out of Brown. I went to Penn, by the way, so any jokes I make are, just whatever, Ivy League yak. And you were there for 2 years, and you went back and got your MBA, and then you got hired in private equity, and then you have a house in the Hamptons and 2 kids, and right, like what could be easier, right? And yes, there is some of that. For the rest of us, and it's interesting, I think Wall Street and investment firms, and you can say diversity in any form you want, but part of it is diverse backgrounds. I was an English major, right? I wanted to be a journalist until I got my first journalism job offer, and I'm like, ugh, maybe I'll do that later. In my 60s, I'll write the book, and now I need to make a living. So I kind of took a job. I did not get the really cool analyst training program like all the other friends at Penn. I had to work. I had to really come in really as a temp in my senior year and walked around the giant trading room and just said, "My name is Jeff Bronchick, please hire me, please hire me, please hire me." And got the job and sort of ate it from the inside. So one of the things that I think is also relevant for Team Brown is, people say Wall Street, what does that mean, right? With investment management, what does that mean, right? There's so many different angles, whether it's equity or fixed, or you're a quant or qualitative, or you're on the sales side, you're on the investment side, or you like to run people, you don't like to run people. Different firms have different cultures. So it's really, until you kind of get in there and poke around. And so that's why, obviously, with the interning programs, et cetera, that you guys are doing, it's you shouldn't, it's like the blind man and the elephant. Just because you go to Blackstone for a summer doesn't mean that's how it is, right? There's lots of other different flavors. And so it took me a while to go, and really at Neuberger Berman, I found it, like value investing, doing things that everyone's not per se talking about, like a smaller select group, a little off the beaten path. That just really mentally kind of excited me. I got my CFA, which I have to say at the time was a good idea. I don't know, frankly, if I studied Warren Buffett for the CFA. I have no idea what the hell they're talking about on CFA these days. I mean, a lot of things that I don't think correlate well to value investing. So maybe, sorry, I do still have a CFA, but I'm not promoting it. But I did it because it helped me, who did not come from that background, to really solidify my, partial skill set, but also this determination. Because I have to say, if someone comes in and they got a CFA or they're studying for it, I know their life is miserable, and they're doing, like they're sacrificing to get ahead. We personally like that. Neuberger Berman, came out to LA in '89 with my girlfriend, now wife, and joined a small and value investing firm that, was some older guys and the kid. And I just Pac-Man worked, out obsessed, out, just loved it. And I think that's one of the things that, after a few years, if you don't find yourself just, and I've been asked sometimes in my career, is this a hobby or is this a job for you? Because I seem to have an unusual dorkiness about it. And it's a good question. And anyway, so after 22 years there at this Recon or RCB, long story, I owned a third of the firm, and I had 2 older partners and a bank, and just tried really hard to move. We grew the firm from 200 million to 4 billion. Yes, I was the leader, but no one does anything themselves. but we just couldn't take it to the next level. And I'm a big believer in, that's why I'm doing things like this, because I'm a big believer in mentoring, and you know, helping people avoid the stupid mistakes that I made, so you can go make your own dumb mistakes. Other people saw it differently, and we decided to, walked in one day 11 years ago and said, I'm out of here in 9 months unless we can get this together. Let's not do that and blow everything up. And we did a very nice deal where the old firm was able to, Randall was bought, and I was able to spin out at Cove Street, strictly doing small and, you know, micro cap oriented value management. We're here, this is our, I don't know, this is our office. This is not one hell of a big conference room in my house. So we've been in every day. And so that's how we did it. And you know, we have 10 people, 9 of whom are partners. You know, obviously everyone's younger than I am. Great open place, physically, intellectually. You can go look at our website if you're really bored. But so that's how I did it. I eat this, love this. I'm the guy who goes home and gets yelled at by his wife because she said, you've been there for 10 hours and you come home, you kiss me hello, and you're reading a 10K in my face. What can I say? Everyone has their problems.
Yeah.
That's how I did it. That's why I did it.
Yeah, absolutely. And you mentioned some student advice there as well. You also mentioned some student advice in a recent strategy letter where you say this leads to another lesson learned in 2021. Young people should join a corporate board as early as they can in their career. Can you expand upon that thinking, please?
Yes. I'm fond of saying things that usually they're really good ideas, but in practice, sometimes not so easy to implement. And the typical corporate board, right, is full of, you know, older retired that, you know, have had their career. And I think 2 things. Number one, that's a problem because I don't care what anyone says, right? You know, if you're 30 something, you're a little more gas in the tank. Let me just speak for well, I'm not 60 yet, but you know, so I hear rumors that you start slowing down at some point in your life. And I don't think companies per se, sometimes, you know, I don't think companies are best served by having a bunch of retirees who may not even have worked for a decade. Or I had a CEO say, yeah, we got to get rid of these people. That person has had a job in 20 years. Like, so what's your connection with how it's really working, how businesses change, how organizations are changing? Secondly, one of the things that, you know, our industry just drills people like you on, you know, quantitative work, tight boxes, rigid structure, some of which, right, like any good idea, that is a good idea. That is really, our industry has absolutely changed for the better with the professionalism and quantitativeness and focus of a youthful generation brought into the industry without sort of the BS of 30 years ago. But the other thing that people really miss is, like, we're buying securities or listed or unlisted, and they're really the small pieces of real businesses run by real people with real incentives or real lack of incentives, with real family problems or not family, mixes of weirdness. And so I think it's very helpful for an investor, and this is what I've tried getting my younger people on, is convincing boards to say, take him, but he's only 33. Like, so what? And I think it's very helpful for an investor to really see how sausage is made, how, like, I don't get it. It's on my spreadsheet. They could just go from, you know, column 7 to column, you know, or column F to column G, and what could be the problem? And you don't really see the mush of the people and what it takes to timeliness to get together, to make a decision, to go through that, and then have it implemented, and how long that takes versus like, hey, look, we're all smart investors, and you know, I got it all figured out. It's on my spreadsheet. And so that's one of the things that we've been encouraging now. So I think it's an interesting perspective. You don't want to spend all your time on boards because you'll just die. So that's one of the things that we've noted. I used to, when I was a youngster, my first go was look at the spreadsheet. Now, frankly, when someone says an idea, the first thing I do is look at the proxy statement. Like, who are these people? You know, are they, as we say, are they stealing with us or stealing from us?
One sector that's very interesting today that a lot of students wanted to know your thoughts on is the energy and natural gas sector. What are your thoughts on that? Is there any part of that sector, let's say upstream, downstream, you know, tech providers, et cetera, that you find particularly interesting?
Let me preface by saying you're talking to a moron who a lot of our work, you know, everyone has biases and preferences. Everyone, because you're human. Some people think that, you know, putting ham and pineapple on a pizza is actually a good idea. I, on the other hand, would not think so. But anyway, so same thing rolls over to investing in industries and your own comfort levels. And you're also, everyone, no matter how hard we're perfectly analytical and how many, you know, behavioral finance books we've read and how cognizant you are of biases, you still haven't, right? You've just only quashed a couple. There's other ones lurking. And so we had a really, I generally don't like commodity companies in general in my career, because I don't care what anybody says. You tell me the price of oil and gas, and I'll tell you what we should do. And I'll also tell you where we should go in the spectrum, right? Should we buy the $200 million, that guy's been in jail twice, but boy, he's got a good nose for finding oil and gas. Or, you know, look, hunker down, buy Chevron, right? This is going to be, you want mass, you want this, you want that. And so we had so I've kind of gone with that, and we've invested from time to time. Again, you're paid to accept risk sometimes, but we had a rotten time in 2014, and everything was right. The right management, the right low cost, all these sort of things that we box check as must have to invest in something that is like this. And it was painful, and so I have to say that we came at it about 2 years ago with, to me, it was so obvious what was happening and didn't execute. To me, again, nothing political or anything, but it's really simple. If you have, for whatever reasons, you are actively cutting off, you know, supply, arguably way before demand's going to go down. So we can talk green, whatever you want. My own personal thing is it's great, but, you know, this is like a 30 to 50 year thing. It's not like, you know, by the end of the next administration, I've got 7 years to fix the planet. I don't buy that. So we saw it, and when we looked, and again, it's sometimes small cap investing is different than large cap. In large cap, we don't do a lot of. We have one all cap. We've got, you know, 4 large cap, easy to buy, big large cap oil and gas stocks, easy to buy Johnson and Johnson. Much harder in small cap to say, well, they just went bankrupt. They came out. It's the same management team. They're basically crazy Texans who like digging holes and burying other people's money. It just is what it is. And again, if you told me that oil and gas is going to go from 40 to 85 with a straight face and complete certainty, and I was, you know, smart or dumb enough to believe you, I would have said, that's the guy we want, right? Not hedged, just a crazy person. So hate poor execution on our behalf. And we ended up buying one company that got taken over and one company that was fully hedged, because it was, and you read their transcript, I just read it today for their earnings call called CNX or CNX Resources. Every value investor, every intelligent investor, everyone who was on this call or thinks it's interesting would say, like, that's the stuff. Those guys are talking my language. Terrible idea. So net, I do think that there are legs. It's, you know, you have to steel yourself in for volatility. I personally, so we have, you know, a smattering in energy. There's ups and downs on the way to the bank. So I think it's interesting. It's a very difficult place to research. Modeling will kill you. It's necessary, but it's really if you think oil and gas on a top-down basis will continue to go for what I just described, then step up. But you cannot, you know, best management doesn't win if it goes from 85 to 40. Lowest cost of finding and acreage, doesn't matter if oil's going back from 85 to 40. Having, yes, balance sheet you think was okay, but then all of a sudden oil and gas goes from 85 to 40, it's not. So I think it's an interesting top down that I try to shy away from. We have a list. We're focused in that area because but it's not the easiest place in the world to make money.
So when you do choose companies in the sector, what are you looking for?
In oil and gas, the least crooked guy I can find. Key things in theory. Let's ignore the prices. Let's say you have the oil and gas down. So really, again, if you think it's, if we're going to go from 85 to 140, because there's going to be this massive draconian shortage and it's just, you want to buy, the smallest, most aggressive CEO known to man. If you don't think that, then you want to be a lot more careful. But in general, and again, here's the problem. 3 years ago, or for most of the last 70 years, a normal CEO of an oil and gas company should scare the heck out of you. I mean, they're just crazy people. In the last 3 years, all of a sudden, post 2014 with this giant crash, every presentation changed to saying exactly the same thing. We're very conservative. We're focused on the shareholders. We're going to live within our means. We have a good balance sheet. We're gonna, and almost overnight, things in theory change. We'll see how that plays out. But having a management team that you thinks about value per share, not just value, because it's easy to grow if you're spitting out shares. Number two, a balance sheet to live through what if I'm terribly wrong. And you can say, oh, they're only 1.5 times levered until you have oil and gas, and all of a sudden they're like talking to the bank. So you have to be really careful about your balance sheet. Thirdly, in theory, low cost acreage and low cost drilling are, some people they just dork out about it. They just love it. I mean, some people they're finance guys and they're hold it. That guy's keep off acreage at $1,200 7 years ago, and you just paid $18,000 through that acquisition. So those combinations of a management who qualitatively you think they're your guys, low acreage, low finding costs, and did I mention just be right? It's that simple, right? So that's on that side. Midstream area, again, it's been a consolidating area, so there's less in small cap. Lot of interesting things going on as far as pipelines reversing and things that were built 20 years ago to take that from there, all of a sudden that's gone and it really needs to go there. LNG, very interesting. So there's a lot of interesting things, and you can choose carefully. They're more what I call yield plus thing. It's not like buying a treasury, but you have to take some risk to get 6 to 8%. But some of the ones like Kinder and I think they're big enough in bulk to have de-risked a disaster. And like everyone, again, just like me, learns from the prior disaster for a certain period of time. So I think you could be in a decent period, should be okay. So I'm net positive, but it's not my favorite place.
Yeah, absolutely. That makes a lot of sense. Thank you. And some students are wondering, so two of companies they have in a portfolio, they both have divestitures of some of their businesses. So Compass Minerals, they've sold their South American businesses and their North American micronutrients business, and Ecovist, they've sold their performance chemicals businesses. What are your thoughts on those sales of those divisions?
Well, if you had interviewed me last Friday, I could have been or I would have been a genius because I would have mentioned Ecovist, and then of course there was a news flash that they're putting the company up for sale. So there's really, I think, two ways that you're making money in investing in general and value investing. One is, you're betting on the sustainability of cash flow growth or getting it right. In other words, sometimes people price, particularly in larger cap companies, they're just, and whether you look at tech or Amazon or Berkshire, you're like, well, look how it did. It's not going to sustain. Therefore, I want to look for something else. And the reality is that getting that right of business model, people, incentives, reason, and you're betting on the sustainability of that. So that's one way. And the other way is, not say obscurity, but just things are changing and people aren't paying attention, right? It's easy to see this, but you're not really, that's it. You just spent 2 minutes looking at Yahoo Finance or in professional case, looking at Bloomberg. You haven't opened the damn thing. You haven't read anything. You're just like, here's a print and here's some statistics that have been drawn up and everything. And no, you don't. And so that's some of the fun for us in smaller cap is because, if you have 100 people turning over a rock, the odds are everyone knows what's under the rock. If you only have 7 or 8, wow, there's like something edible out of whatever you find under the rocks. You can do happy these days. And so that's the thing in smaller cap companies. In addition, sometimes a lot of the work you do, and you have to have a solidity to, I'm not trying to think of the right word, but a lot of work you do does not result in activity. Like most of the work we do it's not per se applicable to something we're going to do at 12:15 today. It's sort of you're building your mental library that you can pluck from over time. And so, for example, Compass was, both of those are different examples. Compass Minerals is the very exciting. It's salt. They're the largest de-icing salt company. No matter what however you look at it. Nothing motivates business activity more than a politician who will be thrown out of business if someone like walks out their yard and falls or skids on a thing because no one salted it. So it's actually a pretty interesting oligopoly. I mean, I know this is old. 80s. This was owned by a company that was called IMC Global, which was it was activisted by somebody somewhere, and we owned the company, and they sold this salt division to private equity at some stupidly cheap number, and I was furious and screaming. I said, this is 1,000 years ago, right? So I kept it. They went public and the stock got creamed, and who wanted to buy salt? I mean, you couldn't ask for more boring. Salt is, it's been around biblical days. It was the original Bitcoin, right before money. It was, hey, I'll take 2 things of salt. So I owned it for 7 or 8 years after it went public, and it's just a beautiful cash flow business, high returns, an oligopoly. They're the low cost producer, all these like kind of goody things. Sold it, made multiples of our money. So, eventually, as Buffett says, like, own a business so good because that even an idiot run it, because eventually one will. Without going by name, one did. It made a terrible acquisition. And again, just, again, talking about boards, old school board, just, guys retiring, they have an ag part of their division, and they said, let's bring in an ag guy. That's exciting. That's more exciting than salt. Just terrible acquisition, terrible at salt mining, terrible at ag. Just all in all, didn't, divisive culture, just things didn't go well. Sorry. And I'm just saying, I don't really care. And we got involved about 3 years ago. And because the stock started to reflect one series of disappointments after another. And in addition, in a company like Compass, which is weather dependent, right? Go snow northeast, go ahead. Salt those roads, baby. But in all seriousness, you can have things that are out of their control. So we got it at a very reasonable price. And we are not activists, but we're active. And it's, we have so many examples of companies that we've either put people on the board on or convinced them of an act. They're not, I think life is again, everyone has a different threshold of annoyance. I really prefer not to, call people stupid in front of other people. In this case, it's exactly what happened. And we convinced the board, number one, to take, it's funny, we actually put forward a board person. It was down to our guy and someone else's person. They chose the other person. They were really apologetic, and I looked at their guy and said, oh my God, he's better than ours. He's awesome. He's now the chairman of the company. He helped get rid of, sort of simultaneous, but basically we got the CEO removed. We have a new CEO in. And so he's basically unwinding the predecessor's mistakes. And he's a very good miner, and salt is mostly mining. So we think this is back to a very high margin, high return on capital, good free cash flow business. And then gets to the next question. What do you do with the money? And that's really, sometimes you talk about sustainability of goodness. What do you do with the money? Because people are prone to do stupid things with money. And now we're at a very interesting juncture with the company of they're beginning to, invest in some growth projects that frankly there's a board change, another board change going on, which I won't say much about, but there's another movement to help them. So if you look at the news, oddly enough, so they have two big assets. One of the big ones is the Great Salt Lake in Utah. And they have been for 20 years mining salt and potash out of there and taking this gooky lithium stuff and dumping it to the side. So now now they're sitting on the largest North American deposit of lithium, but no one cared about it. So there's some interesting things going on there. So we think it's a cheap stock, well run, could use a little help from weather, and you have optionality on the lithium, which literally, I kid you not, they were taking this lithium and dumping it on the side, as opposed to Elon, I hear you're interested. So that's one. And Ecovest, a very, again, pattern recognition. I've been successful 3 or 4 times when private equity takes companies back public. Before this recent craze of anything goes and anything anywhere, if you're going to lever a company 5 to 7 times, in theory, you want a pretty good business that can sustain way too much debt. So free cash flow, some sort of innate steadiness, not wide volatility. And in the chemical space, there's been some specialty chemical companies that have fit this model. In addition, lots of big, dumb chemical companies around the world, nothing personal to anyone out there, but about a big dumb, they're always trading assets or buying assets at top of cycles and blowing it. So there's a lot of movement. And so this company, Ecovest, which at the time is called PQG Chemicals, and this is what everyone thinks private equity is geniuses, right? Oh, they're the world's smartest men. It's such crap. Most are absolutely useless. They just can borrow money like nobody and get paid outrageous sums of money. It's genius. They're smarter than I am. However, so this private equity group, they had this, and they had this, and they jammed it together. They put in a CEO. They went public with a pitch book that was laughably stupid. And of course, people and it was a disaster. So they came out, and so one of the screens we look at are IPOs, failed IPOs. And we got into the stock. We saw it was a failed IPO. It's this looks like a good business. It's still lots owned by private equity. And so advantage sometimes of smaller firms is we can do, hey, it's 70% owned by private equity and only 30% public. Fidelity, forget it. They can't do it. It's too big. Whereas, so what? It only trades 16,000 shares. We can be patient. We can do that. And what we noticed here is, number one, failed. Number two, they brought in a new CEO. And we did our work and found out about that this guy is just bullets, just incredibly deep, the right guy for the job. I flew to Philadelphia, and I'm not a chemical guy per se. I think 11th grade was my last science class. But I spent an entire day there, just like, okay, one more time. That pipe has what in it? And it goes to here, and then it makes this. And the reality was the company had 4 separate divisions that no one in the world would ever wake up and say, hey, what a good idea, let's put these 4 together, except for private equity. And so this guy came in, and once I met him, we came back, I'm like, I think we're early, but let's see, let's let it play a bit. And sure enough, bad news came first because CEOs are incented to get it all out front. But good leaders, no good sum of the parts for all 4, good free cash flow, and a new tough as nail guy who had a really good incentive package to do this. And he basically, I wasn't there, but he walked into the room and said to private equity, their owners, and said, this is the dumbest thing I've ever seen. If you want to keep me, my job is to dismantle it. And that's what it's been doing for 2 years. Dismantling it. Half goes to pay down debt, half gets a special dividend to us. He changed the name of the company because, what could be groovier than EcoVist? And obviously something else has happened. And his goal was, okay, I've gotten it down to this, and now I'm going to start growing from here. Something has transpired that, possibly the private equity funds are at their end of life of their fund, which is always an example. Or one of the problems in specialty chemical, and this is management and business analysis, always this, that I want to acquire, like, so does everybody. Okay, so what's my multiple? Oh, 8 times cash flow. And if everyone else is valued at 14 times, like, to do an acquisition, you have to pay a premium. And everybody, if you have a poker hand, imagine having to, like, okay, I have 2 good cards and 3 crappy ones. How about, as opposed to discarding, you have to pay people to get new cards? That usually is not a good idea. And so a lot of people, especially chemicals, you're stuck. And he basically, I think, correctly came to the conclusion that I can't do it. It's too expensive for me. And the dilution that his current investors, of which we're a top 10 holder, would suffer and scream about, or it's too much. And so they, again, rumor. There's some, there's the company putting out a press release, and then there's quote, 4 sources close to Goldman say they just completed their final, like, it sniffs right. But the point is that both companies were, on a cursory looked like this, but you don't see what's going on like the iceberg. Everyone just looks at the tip. You don't see what's going on underneath. And I think as an analyst or someone like, you don't have to do the deepest dive on every company the first second you look at it, but it wasn't that hard to, like, go down a half step and go, now that's interesting. That's things have changed from when everyone else just got burnt on it. And I think that's a way to recognize and through work, recognize change.
Yeah, absolutely. And both of those theses are very, very interesting. We had some students who were asking if you could please shed some light on your thesis for Landic Corp as well.
Landic is the worst company you'll ever see in your entire life. It has been run as badly as you can run a company. It acquired businesses, cut vegetables, string beans, salad in a bag, that are just so impossibly dumb. Such bad capital allocation, almost destroyed the balance sheet. I mean, if it wasn't this crazy world in which anyone gets credit and no one gets bankrupt for any reason whatsoever, I mean, they would have under, I don't know how, what was it, 30, oh my God, 38 years. I would say 34 of them, this company should have gone bankrupt. It's only in the last 4 that they managed to get forward. So I looked at this company, your California company, I don't know, 20 years ago. Hothouse tomatoes, really? Go away. But you sort of watch and you sort of this. And what happened was kind of interesting, that 12 years ago, they bought a company called Lifecore, which is a beauty. And I mean, again, it's sort of like, whatever, walking out of a bank and seeing, $100 bill with your name on it. It's like, and then saying, nah, and walking over it and going to pick up a dirty nickel. That's what management did with this LifeCore business. And they have some weird little business, but there's a thing called hyaluronic acid, HA, which originally came from, I kid you not, killing roosters and taking their combs and mushing around and creating this very hypoallergenic goo that, for example, if you have a bad knee, you shove into your knee, or it became thousands of things. It's big on ophthalmic use. It's in, every woman's cosmetic thing. But in any event, it was left alone. And the two successful management teams just buying food and string meat, just all sorts of crap. And this guy just was left alone, who runs LifeCore, to grow. And they turned that goo business, as we say, into an injectable business. And if you literally, more and more drugs are getting actually injected into you versus intravenously. And it's not so easy to suspend, who knew, right? It's not so easy to suspend therapeutic compounds into goo and have it maintain and have it get in your body and have it spread around and all this stuff. And they're really good at it. And it's an unusual thing. So they become this really beautiful business, and pharmaceutical companies are outsourcing their manufacturing of stuff like this. Big companies, big multiples, exciting in growth. And here they are under the bag of tomatoes. And so about 2 years ago, one of the long-suffering shareholders, which was not us, maybe 3, started to make the changes. And through pushing and changing the board and getting the CEO to bring in another CEO who was a food guy, but his job really was to, he didn't realize it at first, but his really job was to sell the food. So net, I know everything's a long story with us. Net, this is a company that looks like some failure, which it was. Underneath, they have this LifeCore business, and if people were paying attention, there was several other key people have been joined the board, which we have been associated with. Number one. Number two, they sold the worst part of their business in November, announced public the string bean business. Never get into string beans. I know Mrs. Robbins, plastics, young man, it's never string beans, ever has, ever will be. And so what we think in 2022, they still have some other food business. If anyone wants avocados, it's for sale. But net, sometime we believe in 2022, this company will have sold the rest of its food, have changed from Landec to rename themselves LifeCore, and really have cleaned up most of their balance sheet and had this beautiful little $100 million revenue growing at double digits with 20% margins, with 20% returns on capital, and a really long runway for growth. And the stock has started to creep up a bit, but the multiples people pay in this business are just crazy. And we don't use crazy, but we use reasonable, which has been wrong, by the way, for years, because reasonable, we would have made so much more money if we were less than reasonable. It was a sad problem we have being reasonable. But we think they could sell this company tomorrow for $15 to $17 like that, and the stock's 10. However, this is what gets an interesting, thing for, team value or studying businesses. We tend to look at it as, what's the present value of the company's operating plan? Like, present value, classic discounted cash flow of management's got a plan, they got a game plan, they think they can grow this, it'll take X much capital to present value back, all the stuff that you guys learn. Versus, that's what I call the bush, versus the bird in the hand. And so here's the interesting thing, and it's the old story of there's about judging people's patience and things of like, you put 2 kids in a room, right? And then you put a cookie there, 2 cookies, and you say, okay, if you sit there for 15 minutes, I'll be back. I'm going to give you 2 cookies or a whole oven of cookies. But if you don't, that's all you get. And like some people have the patience to say, a thing of cookies, that's, present value of the thing of the company, that's so much worth than me. I'll just wait 15 minutes. And same thing in Landec or LifeCore as it be, it's really interesting. You'll have a board, and this is what happens in real life. If someone offered you $15 tomorrow, and you thought, oh my God, I'm up 50% in like a month. This is the greatest thing that's ever happened to me, right? Or, what if the stock is 50 in 3 years or 60, right? What's the present value of that? Now, trust me, it's hard in managing other people's money we could be at 50% tomorrow. How do you not do that? And there's risk and execution. So that's really the story of Blandex. So it's, again, the label says something, but the ingredients, are very, very different. And interesting, again, there's sort of a culmination of you look, you don't, and you're like, change. Something's now happening.
So that's very intriguing, and we've talked a lot about today both small caps and micro caps, and also we've talked a lot about special situations, divestitures, acquisitions, spin-offs, etc. Do you think that really college students should be focusing on the intersection of these two areas, and that should be sort of their primary focus when they're beginning and for research and to learn more and to get more experience and to find opportunities?
Yes and no. Human beings, right? Biological basis of behavior, since we've crawled out of the muck, right? Or every gene in our body says minimize effort to achieve food, shelter, and procreation, right? So minimal, those are the, three basics of life, minimal effort, right? Required. That's why lions sit around all day and do absolutely nothing until they have to eat, right? So in theory, this is always preferred. Like, easier is always better. One of the flaws of value, and as a young person fall the same to it, is like, that's tricky, that's interesting, we're going to outwork those guys, and we're going to do something really difficult, and like, it's 7 steps later, we're going to this, as opposed to like, wow, that is a really good business. I can, that's a really good business. They've had a long growth record, a long good return on capital record, a long record of, allocating capital fairly. The stock is reasonably priced. Why don't we just buy it and do absolutely nothing? Go play golf, wonder about lunch, read books. That's easier. That's always better. And so that's the idea being, like, in life, we always talk about like buffets and grams. What you learn is there's no reason that you have to pick one. There's always the intersection. But buying a really good business that's growing and having people who are like, those guys are good. They consistently good nosed, they're incented like you, board of smart people, and sit on your butt and do nothing. Infinitely easier than some of the things we've talked about, right? Wouldn't it be easier if, you didn't have to do all that work? Or you didn't have to dig, you didn't have to wait until, you didn't need 3 preconditions till you got what you wanted. And so there's always that balance. And again, there's lots of great SaaS software companies, but the math of paying 10 times revenue makes it really, there's not that many Amazons. There's not that many Costcos. And so you can say, well, if you just bought Costco, it was expensive when I was 31. And it's still expensive. So you can say, well, see, but there's not a lot of Costcos. There's more Macy's or, it's not so easy. So it really is that balance of, looking at a wide range. But really, I think for brown value investing, it's a combination of, you want to study business models. You want to go back and read, it's really something. And one thing I like to do is I think 2 years ago, I actually went back, I read every Jeff Bezos annual report from the beginning. It's like, what a dumbass, right? And you read it now, you're like, he said what he's going to do, and he did it. And you could have said after the 3rd year, well, he's done that, he's over, right? He's interesting concept. So looking at business models and studying like the famous really good companies and business models that have had, just companies that most people probably never heard of, like IDEX Corporation or spelled either way, IEDEX or with two X's, are both insanely good businesses that if you had just bought that, your freshman year and did nothing and retired at 60 just on that stock. So there is that. And in addition, but particularly, again, if you're Fidelity, your set is tighter because there's just so many things you can do. Warren Buffett doesn't do all that stuff anymore because he's slinging $150 billion. He can only do another Coke. I need someone to put $20 billion to work. He can't do that. So one of the advantages is, particularly for younger people, whether it's limited capital or smaller firms like ours, because we only run 700 million, is we can do some of the, snarkier, funkier things, but we always try to balance. And one of the questions we always ask ourselves in our decision process, we have this quirky little thing that says, wouldn't we rather buy Tootsie Roll? Now, Tootsie Roll, for you young people, it's movie candy. Remember going to movies and eating candy, two things which arguably, possibly your generation will never do again, right? Because it's bad and you're sitting at home. But in theory, Tootsie Roll was this weird little company that just made movie candies. It was run by, when I first started looking at it, it was run by an 85-year-old man and his 84-year-old wife. The husband, he died at 102. She's still there. She's still CEO. It's crazy. But their 10K was like 8 pages. It's candy, right? It's just Halloween movies. Boom, done, right? So we always ask ourselves, it's the most beautiful business. It always looks expensive because, every single day, they're going to die and the company's going to be sold. 20 years later, by the way, that's something you write down. People are going to live a lot longer than you think as a young investor. Just saying, where we've spent a lot of time clinging really hard to it. But we always ask ourselves, it's literally a question before I buy a stock. Wouldn't we rather buy Tootsie Roll? Like, can't we do something easier and better, cleaner, and not all the work on the spreadsheet is this, it's not this, the pile of research is this, right? Because it's so obvious, and Buffett talks about, and it's really hard to do, particularly when you're managing money professionally. Like, you have a 20 punch ticket, right? Here's your ticket. You have 20 stocks to buy in your lifetime. Don't blow it. If you get anywhere, watch football. Don't do all your, line calls in the first quarter, and then it's the fourth quarter and you're out. And so having that mentality hovering helps, but that's what we struggle with all the time of, it's just always interesting.
Yeah, absolutely. And something else students are wondering as well is, why do you primarily focus on investment opportunities listed in the United States?
I used to think, it's not 100% correct, but I used to say, but it's clearly there's, tens of billions of dollars to say that's the dumbest thing I've ever heard of, is like, look, if I can't beat Francois out of Paris in US stocks, what am I kidding? And vice versa, right? If that obviously, like any naturally decent narrative, has an inflection point where that's stupid, right? There's plenty of, and again, things have changed, right? There's all the tools and technology, and I can zoom anywhere, all the things where, like, I'm not getting on a plane and visiting 17 small countries or cities in Asia proper to go visit a company where I can, go across the street and do it here. So we, from time to time, and one of our larger positions is, of all things, a Latin American cable company called Tigo, Tigo. So we've had, sometimes I've woken up and go, hey, look at us. We got 13% international. Arguably, right, the same things I talked about less people turning over rocks, right, in theory. And you can do that. We have, part of it is clientele. We have some of the largest pension funds in the country, and they're like, you're doing this, right? So you're not, we've got a guy doing, Indonesian small cap. We don't need that from you. From time to time, we might have one, but, that would be 5% of the portfolio, not 40. So I think it is an interesting area. And I know, I think if you, particularly if you speak a language, and you know, I think it's harder to, screen for good companies and, get a sense of culture of how that brand or is perceived. It's not in any way impossible. It's just not innately easier. And I don't think I have an edge per se, but again, from time to time, you're doing this and it leads to this. And it's like, hey, look, there's an international one of those. And just 2 analysts covering it and not 8. Other things that are important are, here's a mistake, the classic CFA mistake. So I gotta remember, like, hold it, this is really weird. US investors value chemical companies at X, and European companies are always cheaper. I'm telling you, for 30 years, you could have come in every single day, and you can come in tomorrow and make that statement. And guess what? You'll still lose money, right? Like saying, well, I should just be buying those and shorting these. Like, no, there's some things behind that. Culturally, how the boards are set up, natural resource position. We talked about energy. One of the biggest beneficiaries of abundant, in our face natural gas example is the chemicals industries. Only a crazy person would build another chemical plant in Germany. It's just nuts. So, there's just, it's another interesting palette, but you have to sometimes learn the rules of the newer game, or a game that if everyone's playing it that way and you don't get that, then you can make a mistake. So obviously interesting. And again, with, differences literally from 30 years when I started, it's tough to get information, tough to get management, tough to get tough to get annual reports in English. Stupid things that now obviously, you can trade and do anywhere and anything. So.
Yeah, absolutely. And for a concluding question today, which events have been most influential in your investing career?
The number one thing that formed me as an investor, and I know this sounds stupid and it's just to me, in 1992, it's stupid, I remember this. I joined a firm where, they had a rule. They had a thing. So we would get a new account. Let's say we got a new account for $10 million and they would have their pitch. And I was like 2 years in then. And, again, I was just about to become a partner before this, and they had a thing like, well, we're going to sell a third of the companies that we don't even know and like, and a third we'll have on a watch list, or whatever, a third that we know and like, and we own too, or some version of that. But the point is, like, don't sell everything that day. And the lesson is, no, you sell everything that day, because you know what? This day 2, it's yours. And if you don't know what you own, or, you can't say, oh my God, the stock's down 30%, but that came in, it wasn't really, yes, it was. You had a chance to sell it yesterday when you first, that's neither here nor there, but I've come around to, like, if I don't know what I'm doing, I want it out. You can trade, and, in the day you were like, oh my God, it's like 10 cents a share to trade. Yes, or worse. So now it's like, it's instant, right? You can do it in a second. And one of those companies was the company called Amatec. And Amatec, which I had never heard of at the time, Philadelphia-based company, or Pennsylvania, they announced this press release that says our earnings stink. We're cutting our dividend. We're selling 2 of our 5 divisions and focusing here, and we're going to be buying back stock. And at the time, that was like Egyptian hieroglyphic corporate finance. Like, what are they doing? Cutting dividend, the earnings are bad. They clobbered the stock. And so, like, okay, now I own it. Now what do I do? Because I'm a stubborn, annoying contrarian, and I just I should have sold it yesterday. I'm going to do the work before I just sell it out of disgust, which is another way to take advantage of people. Is you want to buy other people's disgust. You weren't getting it from me. And what I really realized is they hired a firm, and this was like new in the day. This was really like new corporate finance. This is like, late 80s, early 90s. It sounds so stupid now, but basically they hired this firm called Stern Stewart. And it was a guy named Bennett Stewart. And he he didn't invent the word EVA or economic value added, but he copyrighted it or trademarked it. It was genius because it's so stupid. It's basically, hey, companies have you put up $100, and if you can earn $20 on that business, let's say that's a 20% return on invested capital. Okay, what's your cost of capital? Let's just say it's 10 for giggles. So wow, your earned 20, your cost is 10. That's good. Every day you want to take in another dollar at a cost of 10 and invest it and get 20. Genius, right? That's what they were doing. And they basically they were floundering and all this and that. And they basically had those two divisions gone. We were earning 8 and paying 10. Terrible business. Let's starve or sell that, get rid of that. And those are the good ones. Let's feed it. Let's put as much money as we can into the spread between cost and return. And then our stock is cheap because people don't get it. So why are we paying it out? Let's reinvest in us at, and anyone go pull up the chart of that stock since 1992. And, I wish I was smart enough. So one of the only problems in small cap investing is we sometimes we get taken out because, we are in the institutional money management business. When someone hires us to be a small cap investor, the only flaw, and there's only so many good things, the only flaw is like when we really get one and we've made like 7 or 8 times our money, there might be another 8 times and we're like, you can't, as an institution, as a personal person, you can sit and hold it forever. But it's really hard to walk into a committee and say, well, we bought Microsoft on the IPO as a small cap. So that's why we still have it at $1 trillion. So that's hard to, even in today's age of BS and presentations and lying out there, that's really hard to do. And we don't, so.
Yeah, absolutely. That makes a lot of sense. This was a phenomenal session. Thank you so much for taking the time out of your busy schedule to be with us today. And have a great day.
Well, thank you very much. I appreciate it. Good luck to everybody.
Thank you. Bye-bye.